which is employee benefit. Introduction. For major of the companies, the employee benefit will be a substantial cost, especially the companies which are human power centric. So, for example, companies into software business, the employee cost would be the significant one, and there the standard has significant impact. Now, if you compare with Indian GAAP, there is no major change because AS 15 got revised after the introduction of IND-AS, after introduction of IFRS. So when we introduced accounting standard 15 in the previous GAAP, we had kind of taken most of the clauses or most of the provisions from the IFRS standard. So in terms of post-employment benefit, termination benefit, those concepts we know are all continuing. So nothing major change. So we will not be spending too much time on this, but I will focus on the significant change as compared to the previous GAAP. Okay, employee benefits. As we are aware, there are 4 different types of employee benefits. One is short-term benefit, which is like compensated absences or profit sharing, bonus. Those are the short-term benefits. Compensated absences are one, which are compensation of set off is allowed or comp off is allowed, but for a very short time. After that, if you don't take it, gets lapsed. So those are short-term benefits. Post-employment benefit would include everything, PF, gratuity, post-retirement medical benefit company has, after retirement, till the time you are there, your all medical expenses is borne by the company. So all these are post-retirement benefit. Now, post-retirement benefit can be divided in 2 parts: defined benefit plan and defined contribution plan. Defined contribution plan is one like PF, where company contributes and goes. It basically resolves its liability by contributing. After that, whatever profit, interest is earned is for the benefit of the employees. Whereas in defined benefit, a fixed sum has been ensured, and the company will have to take that responsibility of matching to that fixed sum. Other long-term benefit plan we know, which covers basically leave provisions or sick leave, loyalty bonus, that after 5 years, after 25 years, will be getting particular award, and then finally termination benefit, which is like VRS or other benefit. Now, both post-employment benefit and other long-term plan would be computed based on projected unit compute method, where we apply actual valuation, we get a report from actuary on the valuation, and based on the actual valuation we account for the liability. So again, here there are basically 3-4 charges which will come as part of the actual provision: interest cost, service cost, past service cost, right? Again, the concepts are similar as compared to Indian GAAP. The only difference is actual gains and losses on AS 15 benefits. We used to generally, we used to account everything as part of employee benefit cost. Whereas under IND-AS, only the part which is actual gains and losses will not form part of P&L, but will come in the OCI, other comprehensive income. Right? Finance cost, which is nothing but interest cost, generally that will form part of retirement benefit or employee benefit cost. However, there is a policy choice option available with the company. So whatever is the interest cost, company can regard this as a finance cost. However, once applied the policy, it will have to apply consistently, right? And third is past service cost, which is immediate recognition in the P&L. Short-term and long-term benefit plan. Short-term and long-term benefits plan are now distinguished based on
finance cost is an option or it is mandatory?
No, so it's an option. So basically, the question is the retirement benefit or employee benefit will consist of 2-3 parts: service cost, interest cost, past service cost, now and actual gains and losses. Now actual gains and losses now will sit in OCI. Otherwise, all the 3, interest cost or service cost, will form part of the employee benefit. Question is, can I show interest cost separately as a finance cost and not as a part of employee expenses? There a choice has been given. Generally, the tendency is all the expenses, including interest costs, the policy generally followed by the company is it's part of the employee cost. But an option is also allowed where interest you take it separately out as finance cost, but it is nothing but a finance cost.
because generally your decision to fund it or not is based on your availability of the fund, right?
Right.
So when that is that, then it should be a finance cost.
Right. Right. But it's a policy matter choice. You know, whatever option company wants to choose, they can choose, but it has to be applied consistently. Short-term and long-term benefit plan now will be distinguished based on the expected timing of settlement rather than entitlement, right? So it's basically if the plan is there which entitles you for a long-term plan, but it is expected that the full leave will not be settled. So for example, if you are given 20 days leave, out of which 20 days leave can be carried forward, right? But out of which past trend shows that only 14 will be carried forward, then to that extent of 14 only will be long-term in future. Otherwise, the remaining was short-term. Termination benefit, we know that this is recognized basically on VRS kind of expenditure. Only change, and which is a major shift, is the termination benefit, which is part of IND-AS 37. Here in the handouts probably there are some words missing, I realized. So probably if you want to just copy these 3-4 words which are missing, you can do that. Termination benefit, which is part of restructuring cost, which is within the scope of IND-AS 37, will be recognized immediately, when there is a constructive obligation. So IND-AS 37 has a different approach for restructuring plan. If the company comes out with VRS or other schemes, under Indian GAAP, the VRS cost was recognized only when there was contractual obligation. Right? What does contractual obligation mean? Is when the VRS scheme is rolled out, right? The liability will come not when the scheme is announced to the employees, but only when the scheme is announced and the employee exercises that option to go for VRS. Only when the employee accepts that scheme, then the liability is contractually due to him. In that case, the liability would be recognized in P&L only when the employee accepts. Whereas under IND-AS, the concept has moved from contractual obligation to constructive obligation. And what does constructive obligation mean? It means once you have a plan and if you have a reasonable estimate that liability will come, you need to recognize this liability. Now when you say when the company has a plan, again the plan would mean at a high probability that you have made up your mind that you will go for this restructuring plan. Now that could be established by either board resolution or by top management approval. So once that is there in place, even though formally you have not announced the scheme to the employees or to the union, but since you have a plan in place and out of your whatever total staff strength, if 100 people are targeted, but say 70-80% will definitely come, based on that 70-80% your best judgment, you can provide for that liability immediately, rather than waiting for the scheme to be announced and also getting implemented. And again, sorry, I'll again rectify here. It's not you can recognize, you have to recognize. It's a compulsion. And there are a lot of disclosures which are new under IND-AS. So characteristics of defined benefit plan, what are the schemes, what is the amount and timing of uncertain future cash flows, what are the sensitivity analysis. For example, if you change the discount rate from say 6% current, what would be the liability at 5%, at 7%? If you assume salary growth rate is say 7%, what would be the liability if you plus or minus 1%, at 6 or 5, or 6 or 8. So all these sensitivity analysis with the amounts have to be reported in the financial statement. So a lot of disclosures are actually new under the central benefit. Okay, what is defined benefit plan and how these are actually computed?
This sensitivity analysis is mandatory for every company who are
under IND-AS.
Yeah, we have done for 15, but no actuarial has still given, but they are writing as per IND-AS.
No, so probably as of now you would have done only for opening balance sheet, right?
Yes.
Yeah. So once you have prepared the full financial statement for the entire financial year, that time when the disclosure will come. So so as of now probably you have worked only for 1st April 2016 balance sheet.
16
or 1st April 15, sorry.
16 and 15.
Yeah, but once you actually prepare 31st March 2017 balance sheet, which is the first full financial statement, that will come. Okay. Just an example, fair value of plant assets as on 31st March 2015 is 14,000. Defined benefit obligation sorry, 14,000. Defined benefit obligation is 15,000. Discount rate on defined benefit obligation is 6%. Contribution made to the fund is 1,050, and employee benefits paid is 1,500. Service cost is, current service cost is 800. Right? How do we compute? 14,000 was the opening balance. You accrue interest is 6%, becomes 840. Now, earlier under IFRS as well as under Indian GAAP, there were two rates. Now we used to have two different rates, one for discounting of the liability and also assumption for return on planned expected asset, and that rate could be different. But now that rate has to be uniform, so that expected rate on planned asset has gone. The same rate would be applied for discounting. You will assume the same rate for return on planned investment. So interest rate at 6% gives you 840 of income. Contribution made is 1,050, which you add. Employee benefits paid you reduce from the asset. So expected fair value is 14,390. Now assume this is expected. This you did based on the calculation it should have been. Actual fair value is say 14,920. So this is nothing but actual gains and losses of 530. This is on planned assets. Similarly, liability. This was the obligation, 15,000 opening, on which you accounted interest cost at 6%, you reduced benefits paid, you added current service cost, your expected obligation on 31st March 16 is 15,200. Assume actual obligation as at the year end is 17,410 based on actual valuation. Then the difference is 2,210, which is nothing but actual gains and losses on defined benefit obligation. So this 2210, which is on obligation, and the previous slide 530 on planned assets, then net amount will go to OCI as actual gains and losses. So this is the difference. Earlier everything was actually part of the P&L. Now actual gains and losses will form part of the OCI and not the P&L. So to that extent the volatility and everything will change. And again, as we discussed, the deferred tax on this will also sit in OCI. It will also not go to P&L.
But whatever goes to OCI will be allowed in tax. Why? Till now everything is allowed, right? So now it will not be allowed.
It is allowed the payment by you have to pay. It is allowed in payment between equity is also payment between.
Yeah, but here the payment is made, right? So payment is a different aspect. So payment would have been made.
That you actually contributed to the fund, you will be able to pick it up. Whether it goes to PL or it goes to
OCI, that's what I am saying.
Only the case like payment is actually higher than the charge, and the charge is divided into OCI and P&L. Whether you will get deduction only for P&L part or P&L and OCI both the part. P&L, yeah, maybe. Because if something is not debited to P&L, you will not get deduction even though it is paid. But in that case, even if it's parked in OCI, it will get reversed in OCI, so the deferred tax actually adjustment anyway will be compulsory. Okay, currently short-term benefits are those which are due to be settled within 12 months. Now, amended definition says which are expected to be settled only after 12 months. So this is a change, and you will go by the expectation. Just one thing, the IND-AS definition, IND-AS 1 as well as revised schedule 6 has not changed. So this principle will apply for measurement purpose. In terms of short-term, long-term, what is the for the calculation purpose of measurement, you will apply this definition. But for disclosure purpose, the disclosure will be again as per IND-AS 1 or Schedule 6.
So some of the companies, they have current and non-current on the days of their operating cycle, which may be more than a year. So then in that case, you have to go by. But what I find is that actual
use the mic.
No, so what I was mentioning was that current and non-current is based on the operating cycle. Some people, if they are using more than a year, and when it is more than a year, then actual valuer don't give that. So that's a major challenge, that how that actual gain and loss needs to be worked out. So that's a major challenge. So first you need to inform to the actuary that we are using operating cycle which is different than a year.
Okay, there are a lot of disclosure like narrative description of the scheme, separate disclosure for actual gains and losses from demographic and financial assumption, process used to determine actual assumption, actual benefit obligation, then what is the method used, then quantitative disclosure, asset liability matching strategy. So all these disclosures are actually. The difference between IND-AS 19 and IAS 19 is one that under IFRS the discounting rate what we need to apply is basically corporate bond rate. So high quality corporate bond rate, that's the definition used by the IFRS standard. Whereas under IND-AS the government bond yield rate, that is what we use for discounting. So if on an average, so the average age of an employee is say 40 years and the retirement age is say 58 years in an organization. That means the balance life or balance service to be served is 18 years. What you do is, what is the equivalent 18 years government bond rate? That rate you use for discounting, right? Whereas under IFRS is basically the same duration bond rate, but instead of government it is high quality corporate bond rate. And this is a specific carve out for IND-AS, mainly because in India the bond market is not that developed that you get discount rate so easily. However, there is an exception that if parent is in India, it has got a subsidiary outside which is in foreign country where the market is available for high quality bond rate. That subsidiary can actually apply same principle based IFRS guidance. Difference between Indian GAAP and IND-AS, we have seen actual gains and losses now will be forming part of OCI, whereas earlier it was part of P&L. And termination benefit we have seen that will actually be forming part, or the point of recognition was only when contractual liability comes, whereas in this case now it will be earlier of the two, either when the plan is announced or as per IND-AS 37 where actually it says constructive obligation. Yeah, that's it on employer bill. If there is any question, actually I can take it. Yeah.
As per actual valuation, my company have a good cover of liability for the actual. And we have a good classification scheme of LIC. So the fund value, the asset value is around 1 crore 70 lakhs. We recognize 30 lakhs as a balancing figure to my books of account. So as per IND-AS, will I be required to recognize both 2 crore and show as asset of 170 or the 30?
No, that same principles of net balance. Once you have funded,
yeah.
So the net liability will be shown. Then you can start with the next topic, unless there is any question.
So this is one standard where you will not be using discounting, time value of money, because the idea is that actually would have already considered the time value and on that basis it would have worked out the liability, except for one case where we are talking about termination benefit, and in some cases termination benefits flows over a period. So when there is a retrenchment benefit which are given, sometimes company says that they will get it over a 3-year period, right? In that case you need to use the discounting, although otherwise for the full standard there is no discounting which is required.
Right. So as Jayaswai said, the discounting principle actually as such is directly inbuilt in actual valuation itself. So there is no separate discounting required when the valuation itself is done by actual valuation taking care of discounting. Okay. IND-AS 102 share-based payment. The concept is not new. We have been hearing ESOP and other plans of corporates to its employees. So as such concept we are aware of. Now only thing is there was no specific accounting standard under Indian GAAP. There were guidance notes earlier in the past. It got revised 2 times. So now we have a specific standard itself on share-based payment. The major difference is this is not only employee share-based payment. This covers all the share-based payment. So even if you pay a vendor by issuing shares, to acquire fixed assets, that also gets covered under IND-AS 102. Earlier, if you have acquired fixed assets by issuing shares, that would still be covered under fixed assets, but now that has been changed. The number of entities have been using stock options as a part of remuneration package to employees, especially the growing companies, the startup companies, they would be the growth stage. So probably the incentive would be, rather than paying in cash, they would be giving ownership rights, to the employees, which gives self kind of more motivation to employees to work hard and give strategic inputs. As per a recent survey, 71% of the company had stock-based incentive in place. This I am talking about India. So that percentage also signifies how frequently and how regularly the corporates have been using ESOP scheme. Now, ESOP scheme could be on its own, where the company has given shares as part of the scheme, or it could be scheme of its parent company sitting abroad somewhere. So you'll have cases like Indian subsidiary company which is listed here, but still the shares are issued by parent company listed somewhere abroad. For example, Hindustan Unilever employees get shares of Unilever parent, right? Or Abbott India gives shares to Abbott India employees, but shares of Abbott Laboratories US. So these are the examples we have seen, and so both combined accounts for almost 71% of the total corporate. The objective of this standard is to specify financial reporting by an entity which undertakes share-based payment. Okay, share-based payment actually covers both equity settled and cash settled. Equity settled means something where the obligation is settled either in its own equity or by equity of any other corporate. And cash settled is something which is settled in cash other than equity. A third is where the obligation could be settled in both equity as well as cash. Scope, it applies to all the share-based payment, not only employee but even vendors, consultant, right? Legal consultant, auditor, of course, auditor cannot take share, but otherwise any professional who gives services by taking shares, the standard would apply. Fixed assets, if the shares are issued and asset is acquired, in those cases also the standard would apply, right? Business combination, there is a separate standard, but if it's not a business but only fixed assets are acquired without business, then the standard would be applicable. Recognition of cost, that we are aware the cost would be recognized on the vesting period, from the date when it is announced till the vesting date. First measure would be grant date. So grant date to vesting date is the vesting period over which the amortization would happen. How to measure? Again, here there is a change. The measurement till now under Indian GAAP, we used to have two different methods: intrinsic value and fair value. Fair value was not compulsory to be applied for accounting. However, the guidance not say if you apply intrinsic, it is fine, but you need to give disclosure for fair value. Whereas under IND-AS, the accounting has to be based on fair value. Intrinsic value concept has gone now. Majority of the cases, the company used to go for intrinsic value. Even the big corporates generally had gone for intrinsic value. Now they will have to change the assumption and will have to do the valuation as per fair value, and the charge higher or lower, it could actually change. If you have to compare Indian GAAP and IND-AS, first of all, the scope actually covered only employees and not any other party, whereas under IND-AS it covers all the parties. The method measurement, as we discussed, it was only intrinsic value. The fair value was also allowed, but intrinsic value was also allowed. But if you apply intrinsic value, the disclosure as per fair value was required. However, under IND-AS, only the fair value method is allowed. Unidentifiable goods and services. So if you issue shares for services or goods which cannot be identified in a contract, you are acquiring say 2-3 assets, out of which 2 can be really identifiable, 1 is not identifiable. Like you are acquiring a company with customer rights as well as a building. Building is identifiable. Customer rights, even though it's part of the fixed contract, but you are not able to identify clearly. Those also will be covered under IND-AS. And now what it says is, under IND-AS, the value of identifiable assets acquired minus or in compared to what you have paid actually the fair value, the difference would be attributed to the unidentifiable goods and services. Share-based payment among group entities. So if the holding company gives shares to the employees of subsidiary company, because it is not issuing share, was not accounting anything under Indian GAAP, because there was no issuance of share, as well as there was no cost attached to it as far as subsidiary company is concerned, even though the benefit was given to the subsidiary company's employees, right? The employees are giving services to subsidiary company is enjoying the benefit, but the shares are of holding company, no accounting in subsidiary company. This is going to change in IND-AS. The charge would be recorded in the subsidiary company as employee benefit. So you debit employee benefit. What do you credit?
Current liability.
Current liability. And have you settled current liability?
Paying.
But payment is by holding company.
I think it's equity wrongly.
Right. So it is like a grant, you know. So grant from a parent. So you won't credit current liability. You will create a reserve account, which is basically nothing but a capital contribution, and it will form part of your equity. Understood? So it is basically nothing but a capital contribution by the holding company to subsidiary company. Charge will come as an employee benefit expense or employee cost. The credit will be to equity as a capital contribution by the holding company. No, holding company will, okay, so holding company will show this as an investment in subsidiary company. So shares issued, share capital will go up of the holding company. The debit will go to investment in subsidiary. So investment value, suppose is say 5 crore and 5 lakh shares are issued for the employee, or 5 lakh worth of shares are issued for the employees of subsidiary. The investment will become 5 crore 5 lakh. In consolidation anyway it will get knocked off. Okay. In case of graded vesting, there was no clear guidance. Now what is graded vesting? Say shares are issued or ESOPs are issued with 33% vesting every year. First year 33%, second year 33%, and third year, after the end of third year, 34%, which is balancing, right? In Indian GAAP there was no guidance. So say the total charge is say 1 crore rupee. That 1 crore rupees, ideally 2 options are allowed. You amortize 33 lakhs every year. That was one option. Second option is the first tranche, you know, is a graded vesting. The first vesting happens in first year. So you divide 33 lakhs, take full charge in the first year. Second 33 lakh you divide 16 lakh 50, 16 lakh 50 in first and second year. And the third tranche you divide, one third equally. So in the first year the charge will be much higher in graded vesting if you apply. Whereas if you apply a straight line, it will be lower in first year. Both the options are allowed under Indian GAAP. Most of the companies also are doing graded vesting option, but under IND-AS, the straight lining is not allowed. It has to be graded vesting. No, so equity capital of the holding company will remain because finally it has issued shares to the employees, which is outside group, right? And the second impact is employee benefit recorded by subsidiary. So the ultimate, when you consolidate, it is share capital which has gone up and expenses which has gone up. When I was saying knockoff was basically with regard to investment in subsidiary in holding company and equity of subsidiary company. That will get knocked off. Okay. Fine. So if it's a cash payment, then there will be no accounting like this. So this P&L will be hit and finally it has paid cash, right? So the accounting of grant which you were saying till now, that will not be applicable in your case. Then in your case, what you have done is subsidiary will record employee benefit cost and the credit is cash which has gone to the holding company.
I don't know why, but they have mentioned one of the reasons why they are using this to, SEBI is not allowing to do like this share-based payment kind of thing, where the subsidiary can take the shares of the foreign money and then issue it to the I don't know why they are mentioning this.
No, I'm not aware, because there are many cases where Indian subsidiary has issued shares or the parent abroad of Indian company here has issued shares directly to the Indian subsidiary company's employees. So I don't think there's any restriction. Probably in your case there will be some typical situation.
Maybe on account of a transfer.
Maybe yeah, maybe on account of transfer pricing or some issue. Okay, share-based payment transaction and arrangement. Share-based payment transaction is a transaction where services in goods or services are received from the supplier by one company, and the obligation is incurred by another group company. Share-based payment can be between employer and employee, or it could be not between employer and employee. Where you give shares for a legal consultant or an expert or a supplier of goods or for fixed assets. The debit would be depending upon the item you purchase. So if it's a legal and professional fee, the debit would be go to legal and professional fee. If asset is acquired, you will capitalize the asset, and the credit would be to equity shares.
It could be also to the employees of a subsidiary who are not your employees.
Yeah, the holding company giving shares to the subsidiary company's employees. Yeah. So that is what we discussed. In that case, what will happen is the holding company will issue shares, but the cost of employee benefit will be recorded by subsidiary company, even though subsidiary company is not issuing shares.
Unless it is recovered from the subsidiary.
Yeah. I don't know, but actually, I think there is a Biocon case, right, which allows employee benefit expenses based on ESOP. So whatever you charge off in account is regarded as an expense in income tax also. Yeah, it's for the purpose of the business unless and until the shares are issued for capex. If the shares are issued for capex, then it will be capital expenditure. But if the shares are issued for rendering, getting legal services, or shares are issued for the employees, then it will be a normal case. Because sorry. So, for example, you acquired a plant.
If you purchase capital assets,
you acquired a building, and instead of paying in cash, you issued shares. Then it is a capex. Because what you are getting is a capex item, so you capitalize that asset, and the shares will be issued. Grant date, we know it's the date on which the company or employee agrees for the terms. Now at times it could be different. If the grant date is announced properly in a proper scheme, then it is fine. But if it is not announced in a proper way, then it could lead to different interpretation issues. Date of receipt of goods and services, that we are aware. The date of receipt of goods and services would be the date on which the goods are received or services are received. So basically when the risk and reward gets transferred, that is the date on which goods and services are received. In this case, for example, on 1st January 2016, an entity advises employees of the terms of share award designed to reward performance over 3 years. The award is subject to board approval, which is given on 1st March. So 1st January is when the employees are communicated, and 1st March is where the board approves it. Now in that case also, since employees were aware from 1st January, you can start amortizing from 1st January itself. Vesting and non-vesting conditions. A share-based payment award generally vests upon meeting specified condition. So suppose if the target is EBITDA based, if EBITDA of 25% is achieved or EBITDA of X rupees is achieved, then it is EBITDA based target. Now that's kind of a vesting condition. Or service based. Once employee completes 5 year services, he will be entitled for ESOPs. Then it will be share based payment. Non-vesting is actually something. Non-vesting is something which is not linked to the service or not linked to the EBITDA. It is like if the crude price goes beyond $80, the employee will get ESOPs. Then it has nothing to do with the employee service also and company's performance also. It's totally dependent upon the third factor. Then it is non-vesting. Okay, here is a chart of classification of conditions for receiving share-based payment. So if you go in the top, does the condition determine whether the entity receives the services that entitle the counterparty to the share-based payment? If it is no, then it is non-vesting. If yes, then is the condition a specified period of services? If it is for a period of services, for in return of a 5-year services, I give you share-based payment, then it will be service vesting condition. However, if it is not based on service, it could be performance vesting. And again, in performance vesting, it could be either market vesting or non-market vesting. So if it is linked to the share price, it could be market vesting. If it is not linked to the share price, but if it is linked to EBITDA percentage or some profit percentage or profit target, then it is non-market vesting. Okay, these are the examples of share-based payment.
If you deal with what will be the accounting in the
Yeah, I'm just covering that second slide. So, requirement to remain in services for 3 years. That is a service vesting condition, because there is a requirement to remain in service. If you remain in service, then only you will be entitled to get that. So, it is a service vesting condition. If it's a target based, that targets based on the market price of the equity instrument. So if the company's share price, if it crosses 500, then the employee would be entitled for ESOP. Then it is performance based but market based. So market based performance condition. If it is target based but not on the share price but based on EBITDA margin or based on profit margin, then it is performance condition. And if it is based on some other factor only, basically crude price or gold price, then it is non-vesting. Right? Now, each type, whether it is service vesting condition, performance condition, or market-based condition, or non-vesting condition, each has a separate accounting and for measurement and recognition. That will come in the next slide. Just before that, how do we amortize? And on what period we amortize employee benefit cost? That is on the vesting period. The vesting period starts from grant date. So suppose on year 1 you announce a scheme, then after 3 years the employee would be vested with the ESOPs. On first, second and third year you will amortize. So this is called vesting period. And once the shares are vested with the employee, then the exercise period starts. So year 4 to 10 is the exercise period, but the charge would be year 1 to 3. The entire ESOP charge will be taken over a period of 3 years. This is a simple case. For example, if an employee remains in services for at least 3 years from the grant date, employee can exercise the option at any time before the end of the 3 year, and will be allowed any time he can exercise up to 10 years. The fair valuation of award is 3 lakhs. In this case, it is a service-based ESOP scheme, right? And the amortization will happen over a period of 3 years. Now, 5 you are doing separately. One is equity settle, cash settle. There are different accounting treatment for recognition and measurement both. If it is equity settled, the fair value of equity instrument awarded would be a measurement principle. So you will measure the liability of fair value of equity instrument. The measurement would be grant date. So on grant date you will recognize the liability. And after that there is no remeasurement. So once you recognize a liability, you will not revisit that liability. The liability will continue as it is over a period of time of the vesting period. You will not revisit every year. Whereas if it is a cash settled, the liability would be revisited every year. So if the liability changes, the fair value changes every year you will do a true up of the ESOP cost. So that's the major change between equity settled and cash settled. Again, just summary timing. When goods and services are received or obtained, recognition would be either it could be expense or it could be asset. If it's a capex or plant purchase or machinery purchase, the debit entry would go to asset side or expense side depending upon the underlying asset or underlying item what you receive against ESOP. And the credit entry could be equity. If it is equity settled, the settlement happens in equity is equity. If the settlement is not happening in equity, for example, SARs, where it's called stock appreciation right, where the rights are given, the benefit is linked to the share price, but the settlement is in cash, then it is cash settled, then it is a liability. So you don't issue share, but whatever is the share price, based on that share price, you pay cash to the employee. That's called cash settle. Now, here is the, we divided all these ESOP schemes into 4 parts: non-vesting condition, market condition, service condition, and non-market performance condition. Where we say non-vesting condition is something which is totally different, not linked to the services of the employee and also not linked to the target. Something like, if crude crosses $60, which is not linked to employee rendering services and also not linked to the EBITDA margin or profit margin directly with the company, right? Indirectly, maybe it may be benefiting the company, because if the crude price goes in a certain direction, it could lead to profit in a good or bad way. But now, since it is not linked to the EBITDA margin or profit margin and also not linked to the services, it is non-vesting. Or market condition. If the share price of the company who is issuing ESOP, if it crosses 500, employee is entitled for ESOP. In that case, it is a market condition. Service condition is where employee is given ESOPs for rendering services. So employee serves for 5 years, he will be entitled for ESOP. That is service condition. And non-market performance condition, which is EBITDA based or profit margin based. In non-vesting and non-vesting condition or market condition, we don't true up. After recognizing the liability, we don't true up. And in service condition and non-market performance condition, true up happens every year. So every year you true up exercise. So that's the difference, and that's why this classification is very important. And as we are aware, so ESOP charge would be total number of ESOPs issued and fair value at the date of grant into whatever is the expected percentage to get settled. Right? Only thing is, granted fair value of option will be remeasured if it's a cash settled share based payment. If it is equity based share based payment, then no remeasurement. Yeah, it's only one time. If it's a cash settlement, then every year we have to see what is the current fair value as at the year end date, and the true up will happen every year. If it's for yeah. So if it's a simple vesting, if it's not a graded vesting, if it's a simple vesting, then it's over a period of straight line 3 years. Okay. Right. No. So if it's a equity settled, then there is no remeasurement, because the equity value, once it's fixed, it will be remaining fixed. However, if it's a cash settled, where no. So I'll give you the example. So suppose I am giving shares to my employees. I am saying you are entitled for equity of rupees 100. The fair value as of now is 100, but I am giving it to you at 70, right? So assuming the fair market value, I am just now giving you intrinsic example. So intrinsic value in this case is 30 rupees. Assuming the fair value also is 30 based on like and short model or whatever, then 30 rupees you will amortize over a period of 3 years. If it is equity settled, because finally I am going to issue equity shares to you, right? That's a simple scenario. If it is a cash settled, where I am giving an option, or I am giving an option where I will not be issuing shares after the end of 3rd year, but I will say whatever is the market price after the end of 3rd year, that market price minus your current price of 70, whatever is the difference, I will give you the cash settlement, right? In that case, it's a cash settlement, and hence the measurement happens.
So for that reporting period is every quarter, or it will be?
If you are making a quarterly results, it will be every quarter.
Every quarter will be
Every quarter. Because accounting standard says, for quarterly reporting, you have to follow discrete approach, as if that is the accounting period.
I am not getting equity settled in the first place, I am just
In cash settled
option.
Right.
And in the second case, I am taxing the option, but I am getting the value.
Yeah, so in equity settled, the equity settlement is always through equity only. Only the shares will be issued. In cash settled, it is the cash
Value I am getting.
Yeah. Again, this is a broad term, but actually there is a detailed chart. What is equity settled and what is cash settled? So that is also important. And entity granted share options to a director on the condition that the market price of the related share increases by at least 15% each year over the next 5 years. At the end of the 5 years, that this target was not made. Right? So this is what this market price share. The entity cannot reverse the excess price or the expense because the remeasurement is not possible when it is market-based condition. An entity grants share options to a director on the condition that the director does not compete with the reporting entity for a period of at least 3 years. The fair value of the award on the date of grant, including the effect of non-compete fee clause, is rupees 1,50,000. In this case, it is non-compete clause, which is basically not a vesting condition. It is not linked to the service, it is not linked to the EBITDA or profit percentage, it is not linked to the market price of the share, it is non-vesting condition, right? So in this case, you need to charge off this immediately. Cash settled. An entity grants 100 cash settled award to its 500 employees. So here the settlement is not through equity. It is cash settled. So you measure every year. If had it been equity, you would arrive at the fair value. The fair value remains same every year subsequently. In cash settled, the remeasurement will happen every year. Okay, now what happens? In year 1, 35 employees leave. So from 500, 35 employees leave. The entity estimates that 60 additional employees will also leave in year 2nd and 3rd. So even if this have not left, you assume that another 60 will leave. So 95 is out of the system, right? So that true up of 95 would be required. Again, the share price has changed. So all this true up for employee leaving, the share price change, everything will be considered in the subsequent charge. So just to give you example, 95 employees from 500 has been removed, so employees are 405. Number of ESOPs remains same, but the price changed, so 40 rupees into 1/3. This is the liability, 5,40,000. Next year, suppose out of 5, number of employees further go down and fair value goes up from 40 to 50. Then it means you need to have a charge, liability of 13,33,000. Whatever you had recognized till last year, the difference will be recognized in the current year. Similarly, 3rd year, suppose 3 employees are added in the system, but the value of benefit goes from 50 to 52. So that means you need to have cumulative liability of 20,95,000. You already had 13 lakh. Whatever is the difference, you will recognize in the current year. Right? So bottom line is true up will happen every year if it is cash settled. Okay, classification of share-based payment transaction group arrangement. Remove what can be removed. The slide is final. Does counterparty get my equity instrument? If answer is yes, if I am giving shares, it is equity settled. Does counterparty get equity instrument of another entity in the same group? Say for example my holding company. Yeah, if yes, can I provide those instruments? If I am providing, then actually it is cash settled. But if I am not providing, the shares will be issued by the holding company itself and I am not going to pay any cash, then again it is equity settled for subsidiary company. Because for subsidiary company, if subsidiary company is issuing its own share or if it has no obligation, in both the cases it will be equity settled. Right? Otherwise, it will be again depend, does the counterparty get cash based on the value of either my equity instrument or equity instrument of another group company? Answer is yes. Do I have to settle the obligation? If answer is no, equity settled. If I have to settle, it is cash settled. Broad summary, if I have to just summarize in 2 lines, if the company is issuing its own share, it is equity settled. And if the company has no obligation at all, it is equity settled. In both the cases, it is equity settled. In all other cases, it is cash settled. Right? And what is the relevance of equity settled and cash settled? If it is equity settled, you will not remeasure every year. If it is a cash settled, you will remeasure every year. Again, this is a tabular form, the same chart here. So this is a simplistic case number 3 if you take. subsidiary issues, who grants the settlement? Subsidiary. Entity which receives the goods and services, subsidiary. Entity where shares is award based on is subsidiary. Everything subsidiary. Settled in shares, yes. It is equity settled, equity settled. Equity is settled for subsidiary. It's a pure vanilla case, The pure vanilla ESOP scheme is issued for the benefit of the services received from employee. It's all equity settled for subsidiary also, and at a CFS level also it will be equity settled. Now, we have considered the simplest case, which is 3. Now let's go to case number 1. Parent is giving or granting shares for the benefit of the subsidiary. Shares are issued by the parent. Settled in shares or cash shares. For financial statement of parent, it is equity settled because finally parent is issuing share. If parent is issuing share, it is equity settled. For subsidiary also it is equity settled. Why? Because subsidiary company has no obligation. For equity settlement, the two conditions are either no obligation or my own equity. Since the subsidiary has no obligation, it is equity settled for the subsidiary also, and for the group also it is equity settled. Another example, subsidiary company granting the share for the services received by subsidiary, but the parent company's share, the compensation is based on settled in shares. This is in separate financial statement of parent, it will not come because finally parent is not issuing also share. For subsidiary company, it is cash settled because it is settling the obligation. Subsidiary company itself is settling the obligation, but not in its own equity. So for subsidiary company, it is cash settled. But when it comes to CFS, it is equity settled. So similar, what we actually saw here, basically it's populated in a tabular form, but otherwise principle is same. If the company is issuing its own share, or if the company does not have obligation, the obligation is borne by the parent company. In both these cases, it will be equity settled. Otherwise, rest in all the cases, it will be cash settled. Now, modification, cancellation, settlement remains same. So if there is any modification, whatever is the extra charge, that will be taken over the balance life. If there is cancellation or settlement, that will be also when the cancellation happens, that time that charge will be recognized. Any payment made to employees on cancellation or settlement shall be accounted as a reduction of equity, and any new equity instrument are granted to employees, for which gives additional benefit. That additional benefit also will be amortized over the remaining life of the option. Coming to disclosure, there are a lot of disclosures which are required now under ESOP, which is basically type and scope of the agreement, the description of the agreement, the number of and weighted number of exercise price, average share price, range of exercise price and remaining contractual life of option, valuation method used for fair valuation, black and Scholes method or whatever methods you have used, that need to be disclosed, and the impact of income statement and financial position of share-based payment award. So these are the disclosure. Not all are new, but there are few new. Many of these were actually there in the previous gap also. So that's it on share-based payment. If there is any doubt again. On the day of grant. So when when you are announcing, that time the scheme would lay out, whether you are giving your own share or whether you are giving shares of a parent company, or how the liability will happen. So if you are giving a scheme where the employee is entitled for equity shares, the settlement will also happen through equity share. That scheme only will say it is equity settlement. Whereas if the scheme says that the settlement will happen in cash, LPU cash, based on the share price of the company, but settlement is happening in cash, that means it is cash. Yeah. No, it says fair valuation, and there are. Yeah. Generally, it is black and Scholes model, but as Jayesh said, there are new methods now which have been introduced.
I don't know, because auditors are insisting on using binomial modeling or Monte Carlo simulation model for valuation.
Generally, I will black and Scholes.
Yeah, see, earlier black and Scholes model was used,
that
But-
was also prescribed. No, in the guidelines.
Yeah, so what has been found over the years is that if some of the assumptions are not properly fitted, it gives absurd results. And that is where there are new methods which are coming, and they are supposed to be more sophisticated. Maybe after 3 years you will come to know how sophisticated they are. But people are using different methods now. Previously it was only letters.
Even valuation of phantom stocks will be covered by this rule.
Yeah. So phantom is nothing but cash settled.
Yeah, cash settled.
So anything, if you don't issue your shares, it means it is a cash settled.
Friends, before we wind for the day and we propose a